Welcome to another segment of Freyman CPA. Remember, here at the office, your success is our success all day, every day. Right, Ange?
That's right.
That's right. So we're going to talk about state tax residency issue today. And this has been a hot topic for many years, although many of you probably have not heard about issues that come up with state tax residency until COVID hit and everybody started moving around and playing musical chairs with the states that they were residing in for tax purposes. Now, whether or not you knew this, but there is such a thing as state tax residency audits. You might be thinking to yourself, what's a state tax residency audits? And don't you just get up and move to another state and call it a day? No, that's not exactly how it works, unfortunately. So let's see. Let's talk about in general. Okay, so this segment will deal with state tax issues, and remember that we have different layers of taxation, and we have the overall federal tax code that deals with federal taxation is for all the states and is its own law, its own rules and regulations, and it deals with federal tax code. Today we're going to talk about state tax laws and rules and regulations. And this is state taxation segment, okay? So don't confuse the two, but very much like with the IRS, you know, you have one thing that's taxable in your state of residence, and that one thing is everything. Or like we say, for federal tax purposes, your worldwide income. All right, so tax residency audits is a thing. And, you know, let's talk about Jock Taxes real quick, and I am not throwing out derogatory terms. This is an actual coined term. If you Google it, you'll see what Jock Taxes refers to, and it refers to professional athletes. So professional athletes tend to live in income tax-free states. And you might be asking yourself, well, why? Well, very simply, because here's a professional athlete, and if the professional athlete plays in state A, physically there's going to be tax implication. And they're going to owe taxes there. And they also live in state B, tax implication. And yet they also practice in state C. That's where the home team is. And they earn income there too. So as you can see, if I was a professional athlete, which I wish I was, I'm not, but if I was, I'd move to Florida. Because Florida is an income tax-free state, folks. So if I'm already getting slammed with A and C, I'd rather already cross out B. And guess who had a very similar kind of situation and did a very similar type of move? You guessed it, Derek Jeter. So Mr. Derek Jeter is a New York Yankee, as you know. And what Derek Jeter did is he went from New York and moved to Florida and basically was pulled back into New York for residency tax. And they said, well, Mr. Jeter, you're a New York Yankee. You work in New York most of the time. All your stuff is here. You're basically an icon, a New York icon. There's no way you're a Florida resident. And Derek Jeter tried to actually make it so that he's a Florida resident. And I'll dive into the details, but what he actually did was he spent a significant amount of time in Florida. He bought a home in Florida. He had a car and banking, and maybe even registered to vote in Florida, and he did all these different things to establish tax residency in this state. Why? Well, because New York is a really high income tax state. Between New York and New York City, you know, you're looking at almost, maybe back then it was about 13% worth of taxes, and Derek Jeter is worth a lot of money, so 13% on a lot of money is a lot of tax. And so he got that idea probably from his very savvy tax accountant and moved out and decided to establish tax residency there. And I'll dive into the differences in the rules and all that other stuff. But that's the story. Now, the burden of proof in our world, much unlike the legal system, is always on the taxpayer, which means that we have to prove our innocence, and it's not like in the legal system where you're innocent until you're proven guilty. But in the case of Derek Jeter, he actually was saying, well, you guys, well, New York's pulling me back in for a residency audit. You should prove that I'm a New York resident. And so that was one of the exceptions, but yeah, we don't know exactly how it all ended because everything was settled out of court. I'm assuming that Derek Jeter had to pay up. All right, so that's Jock Taxes, living in income tax-free states, the burden of proof. Let's talk now about what all this means and some of the very important aspects of state tax residencies. So in the world of state tax residency, we have two terms, and let's talk about the first one, that's domicile. And you might have heard about this. So domicile, you can only have one. Only have one domicile, and that's your near and dear. And that's like your home sweet home, like you've seen that little picture frame that you'd put up and say home sweet home. Well, that's kind of like your domicile. And again, for tax purposes, you can only have one. And actually, it's slightly different for each state. And legally speaking, each state can define domicile slightly differently. But in general, you know, things that reflect domicile would be your near and dear, your family, your home, your business, right? Your voter registration, professional affiliations, like for example, your licensure, or maybe where your doctors and lawyers are located, even where your pet's veterinary, yes, that's right. They look to see where your pet's veterinary might be. So they look at, so the point here is you might have only one, but there's many factors. Factors aplenty. And it's not just one single factor. So I can't just move to Florida and get a voter registration and basically call myself domiciled in Florida. If I were to be audited by New York, they would weigh all of these different variables and time and all these other things. They want to know exactly. And again, like I said, some states vary what they give weight to. So Utah is interesting because Utah kind of looks at voter registration kind of heavily in ways that, like, what are you, committing voter fraud? You know, why are you voting here? That's quite serious, and it might not be anything intentional. But anyway, so again, domicile is many variables, and when clients come to our office, sometimes they talk about, well, I bought a house here and I'm registered to vote here, but that doesn't mean you don't have a house back there, and maybe your family's back there, and maybe your business is back there, and your banking, and so on and so on. So you have way more variables tying you back to wherever you came from to outweigh where your new domicile is, and again, you can only have one. So that's the thing with domicile, all right? And again, it's a kind of a gray area because there's so many variables, you could never just say one and you're done. Now, so that's the term. So I want you to just keep in mind that term, and it's quite important because now we're going to introduce the second term, and this stuff's going to blow your mind. So we have domicile, and we also have what we call statutory residency. All right, and statutory residency, you can have more than one. So here's the eye-opener, is basically I can be a tax resident of, let's say, New York and New Jersey. Whoa, I know, just completely blew your mind. So that's right. So statutory residency is you can have more than one. And we actually have clients for many years that are statutory residents of more than one state. And what is statutory residency? How do you become a statutory resident of a particular state? Well, most states adhere to the 183-day rule and living arrangements. Okay, so you have to have both of these. So I had to have spent over 183 days within a state and have a living arrangement, or what we call an abode. Abode. And an abode could be a property rental. So it doesn't even have to be mine. I could just be renting a property, or it could be one I own. So that's statutory residency. Now, for our clients that do have these multi-state tax implications, we actually recommend an app, and the app is called Modea. Let me just find the right spelling of this if I can find it. Monea, I apologize. So it's Monea for audit defense. And this app tracks how many days you're actually present where you are geographically from the sky. It's monitoring somehow where you are and keeping log of it live. So there's no way anybody can rebut it, because it was actually doing all that fancy footwork from up in the sky. And it basically is like a timestamp. It shows where you were moving. I guess before that, people kept logs, and yeah, you can still keep a log and prove it other ways, but for those that are worth quite a pretty penny, this is a surefire way of creating some great audit defense, because you know that's solid. You don't have to do anything but just keep an app. And yes, some people will be very careful with spending. If they have the living abode, they'll be counting every day they're in a state to watch out for double tax. All right. So that's the statutory residency. So you have that 183-day rule and the living abode test. Now, let's talk a little bit about double taxation. All right. So since you have more than one state of residency, you might ask yourself, well, you know, if you're in New York and you're in New Jersey and you said you have clients, does it sometimes happen that they couldn't spend that smaller than 183 days and they were forced for whatever reason to spend over 183 days? Don't they end up double taxed? Yes, they do. So they end up paying taxes here and they end up paying taxes there. But let's just say in our example, their domicile is here. So remember, you can only have one domicile. So that in our example, our client was domiciled in New Jersey, but for whatever reason, they spent 200 days in New York and they have an abode. So whoops, what happens? They become a statutory resident here. And now they pay taxes here. So to alleviate this burden of double taxation, their home state, their domiciled state, will offer them a tax credit for the taxes paid to the other state. All right, since it's that's the typical scenario. That's when it can happen that way. That this is not to be confused with reciprocal state tax agreements. So reciprocal state tax agreements is basically when you have one state is in agreement with another state, like New Jersey and Pennsylvania have a reciprocal tax agreement, that if a New Jersey domiciled resident goes to physically work in Pennsylvania and they're working on employment, in other words, they're not earning any other form of income besides wages, then they're exempt from taxation in PA, in Pennsylvania, and they would only pay taxes to New Jersey. They would have to fill out a specific PA exemption form to be able to do that. Okay, that's very different from receiving a tax credit, which is filled out with a form on the resident return and requesting a credit for New York. And this is a very common thing, because besides a tricky situation like statutory residence, where do we see this happen quite often is when people commute. Before COVID, right? Most New Jersey residents would work in New York. This is quite common, or Connecticut. Residents would commute to New York, right? So it's New York source income. It's income that's sourced to New York, and that's really important, and I'll get into that in a minute. So the income is sourced to New York, and so they have to, and they're physically there, and New York is a physical presence state, like many are, and if you're physically in New York and you're physically making money there, you're going to owe taxes So that because your employer is there and you're physically there, and now so you're going to pay taxes there, but you're domiciled in New Jersey or Connecticut. This is your home state. So what ends up happening is you get a tax credit on your home state for the taxes paid to the other state. All right. So the tax credit is to alleviate that double taxation, but the problem is that a state like New York might have a higher rate, and the way the tax credits actually calculate, you will pay the taxes there, and then you'll get a credit on the home state, but the home state will not offer credit large enough to offset the entire taxes that are being generated on the home state. So you end up with a double tax anyway, an overlap. And that's not always the case, but it is a situation that does arise, and how much that double tax actually equates to is different for everybody because each situation is unique. That's to say that we don't know exactly how much, but it's usually not a large overlap because they do tend to alleviate as much as possible, but it does happen. So that's the tax credits, that's the reciprocal tax agreements, and that's how those work. Now, let's talk about, now that we talked about that it doesn't wash out, we talked about the app. So came along COVID, and COVID has really changed the playing field, and we're seeing a lot of interesting cases for the 2020 tax year, like New York and Florida. So New York came right hot out of the gate and said, well, we know that people are moving out of the state to like states to Florida, but they're basically saying, well, because don't forget, and I'm going to talk about this, might as well talk about it now. So New York has a very aggressive residency tax department, as you can imagine with Jeter, right? So right when COVID hit, they were hot out of the gate, and they came out with this convenience of the employer rule, and we have a small video on it by Angie where she discusses the situation where basically if somebody's moving out of New York and their employer is still here and their wages are still there and they moved out for COVID purposes to, like, say Florida, that's still all New York source income. Then they said, well, that's the convenience for you. You moved out to Florida for your own personal convenience. You didn't have to do that. And it wasn't like it's a new branch here that they established in Florida. It wasn't like there's relocation and there's a Florida branch and that the employee is working there now completely and the source income is Florida. Everything's the same except the person just, did musical chairs and moved over a seat. So everything's still taxable to New York, and people were coming to us in the tax season saying, well, why do I owe New York State income tax? Well, because it's all sourced there, and because New York is very quick on the trigger and said, yep, it's convenience of the employer, and you know what, too bad, you owe us money, whether or not you move to Florida. So that situation has been arising, and other situations is very similarly, you have people that move to, like, let's say, luckily Florida has no income tax, but a state like Maryland does. And Maryland's a physical presence, just like New York is. So people that are here, from New York, they're still domiciled in New York. They're still New York residents, and the income is being sourced to New York and everything. And they moved for COVID and spent, let's say, 200 days here in Maryland. Well, guess what? Maryland is a physical presence taxing state, so Maryland's going to want a piece of that and should be taxing that taxpayer. However, New York says, yeah, but that's also my income. It's sourced to me. We don't care that this person moved out. And guess what? Since it's sourced to New York, there's no tax credit. And these are the kind of issues that are arising now with this COVID situation that are really, real traps. And you got to watch out for this. And this is where we can help. Obviously, we're in 2021. 2020 tax season was wild. And 2021 is still evolving. We don't know how all of this is going to play out. Like I said, New York's an aggressive state, but states like, for example, New Jersey or Connecticut, New Jersey traditionally hasn't really had a residency tax audit. So people moving out of New Jersey left and right, and nobody's being audited. But states like New York, if you are over $1 million person, you're guaranteed to get audited with New York. If you move out of New York, it's like a guarantee. And Connecticut's similar. It's easy, and like right now when they're dealing with 2020, they basically gave a free pass to everybody. They're not aggressively going out after everybody, and then they're just not well equipped to deal with that kind of situation, whereas New York was hot out of the gates. All right, so that's basically covering you know, the employer rule and differences in states and the twists that we're seeing with other kind of scenarios. And there's many kinds of scenarios out there, and depends on the states and what they have to say. So it's really quite a convoluted map to navigate, unfortunately, because there's just so much to it, you know? All right, so that's, I jumped ahead there a little bit, fine. Now let's talk about some of the various spins that we have. So we talked about statutory residency. So typically that's 183 days plus BODE, right, living arrangements. Now these following states, Oklahoma, Oregon, and North Carolina, have their own spin on statutory residency, where instead of 183 days, they go with 7 months. All right. Oregon has a 200 days. And North Carolina has days only. Doesn't look at domicile. No, I'm sorry, no BODE. No BODE. So just the days. All right. So that's some interesting twists. Other states look at a BODE only and don't have a statutory residency rule. All right, and so we're going to call this domicile only. Domicile only states, sort of. They have their own kind of spin on things, obviously, but Alabama, South Carolina, we have Wisconsin, Kansas, Minnesota, and New Mexico. All right, these guys are looking at domicile only, sort of. All right, then we have sort of like a hybrid. And we're going to do a topic on, before that, Ohio. Ohio is an interesting state because they have a bright line test, okay? It's kind of like a domicile test and a contact period. So they look at domicile and contact period. And they define contact period as 120 to 183 days. So anything below 120, you're kind of in the clear. Anything within this period is you're kind of presumed domiciled, presumed domicile. And here is presumed not domicile, and here you're just a plain old resident. Anything above 183, plain old resident. So very straightforward. So like I said, don't run with everything you see here. This is pretty general information. You got to deep dive into everything. There's differences and cases, case by case. You know, it's never going to be this black and white. These other states are kind of like domicile or statutory. Or statutory. So they're kind of looking more at, and we're going to talk about California in our next segment, but California, Illinois, then we have Arizona, Hawaii, Michigan, and Montana, Michigan actually means great water in American Indian. Great water, that's a little tidbit for you guys. But yeah, so they're basically looking more like at other facts. They don't just look at 1 year, they look at over the years. And they want to see if your temporary transitory purposes are, you know, how much connection you really have. It's kind of almost like looking at things in a deeper dive and doing more of a, what's the word I'm looking for? Form over appearance. That's what they're doing. They want to see things a little bit more in depth. And California and Illinois are very similar in the way to look at things. And in the next segment, we're going to just do a deep dive into California and just discuss California on its own, because California is also a very high tax state. And for those that are dealing with New York and California tax issues, that might mean as much as a 30% tax hit between the two states. So it's kind of important to note and steer clear of any issues with that state, which also has a residency tax department. They're well equipped. Income tax-free states, yep. So we touched upon that, income tax. So now I'm diving into just wrapping up here, because, you know, we discussed what domicile is, we discussed what statutory residency is, what are some common traps, what does it mean to move from one state to another, and how do you attach to a state, what kind of credits do different states offer those that are being impacted by double taxation, and reciprocal state tax agreements, overall history of state tax residency and their audits. So yep, that's how vastly different our states are. And you know, obviously we have some income tax-free states, or what we call retirement-friendly states, and those would be as follows: Alabama, then we have Florida, New Hampshire, Nevada, South Dakota, and then we have Texas and Tennessee, boy, that's a hard one to spell, Washington, and last but not least, Wyoming. Important reminder here, these are income tax-free states, but that does not mean that they have no taxes at all. All right, for example, Tennessee has an investment tax, and I'm hearing that Washington has an intangible tax or a capital gains tax that it might be coming out with, and those again are very similar to, you know, just federal law, where when we're looking at federal tax, right, we have income tax, we have capital gains tax, which is an investment tax, right? We have all these different layers of taxes. So for example, New York doesn't really have like a separate type of tax for different types of income. It just looks at everything you have, and then it just taxes it at a rate system, right? A progressive rate system. Then you get to the top marginal and you pay top marginal. It has many different calculations in how it arrives to the taxable income. That's a separate story. But states like Connecticut actually has the same thing as New York, but it also taxes capital gains separately. I think it was like 5% on capital gains. So that's how vastly different our state taxation can get. And that's why it's very complicated, because you have federal tax laws and you have state tax laws, and then you have differences within the states. It's just complete all over the place. Yep, so that's our income tax-free states. Just because they're income tax-free doesn't mean they're completely tax-free from other forms of income. But as I've mentioned, and that doesn't necessarily mean that they're very friendly overall tax states. For example, if you compare South Carolina, it's way tax friendlier than Florida. Even though it has an income tax, it's still a cheaper place to live for taxation overall. Remember, taxation is not only about income, but you have other types of taxes, and you want to look at the overall tax system in that particular state. And that can include something like property taxes. It can include highway taxes and gas taxes, school taxes, and everything else that we get taxed on, things that we've never even seen, you know, all sorts of taxes that you probably never heard of. So anyway, that's just an important piece of information for you guys. I think that's pretty much it. I'm going to call it a wrap here from Freyman CPA. Stay tuned for our next segment when I'm going to deep dive into California state tax residency issues. And again, I thank you for your time, YouTube. Hope you have a great day out there. And once again, remember our motto here: every day we're helping you keep your money and make the most of the tax system by allowing you to take advantage of the tax code to the highest degree possible legally. All right, legally. So keep that in mind. Freyman CPA, where your success is our success all day, every day. Thank you.